welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Green. This what a way to finish November. We had obviously pretty much a 15% round trip in November, and we'll get to that in just a minute. But in case you missed it, I'm sure you didn't, but in case you did, the Dow Jones finished up 490 points today, 12,045, up 4.25%. I'm not even going to go through all of them. You can see pretty much everything across the board was up anywhere from 4 to 5%. Really strong day. This really all started yesterday evening. We had, during the 4 o'clock hour, we had S&P came, and there was a warning previous that some of the banks around the world could be downgraded based on this European debt. And sure enough, S&P came and downgraded a whole slew of banks, pretty much everybody. And it was very coincidental that yesterday afternoon I was offered some Goldman Sachs bonds to buy. There's still flaky things, we'll call it, going on in this market. We saw the insider trading by some people in Congress and so forth. I posted on the blog, the videos on there from a few weeks ago. But the fact that somebody was selling Goldman Sachs bonds an hour before this downgrade came out stinks. And fortunately, I didn't buy these bonds, but I see these things all the time, and the stuff that was happening in 2008 is still happening today, and so it's kind of frustrating. But so we come in this morning. Obviously, the futures are down from that downgrade the night before. S&P futures down 5 to 7 points, something like that. Nothing major, and they're humming along here, and then right when we get about right here, probably about 5 o'clock Central Time, the market ramps up, and up we go. And it was because China came out and lowered their reserve ratio by 0.5%. And this is essentially how much money the banks have to keep inside the bank and not be able to lend out and so forth. So basically what they're doing is they're lowering that because they're loosening. And that's something that our Fed has done in the past. They can either lower or raise that to tighten or loosen. So they lowered their reserve ratio, and the stock market took an initial bump. Then, so we went from down 50 on the Dow futures to maybe up 50. Nothing major. Then we come along here, and it's announced that there's going to be a concerted effort by 6 central banks, all the big ones around the world, to lower swap rates, which is a complicated thing, but basically another way to funnel money into Europe more easily. And it's supposed to be a riskless trade for our Fed. We'll see, exchanging dollars for euros. And so the futures take off. They're up about 250. Then later on, we get an ADP report, which is an economic report on the employment picture. And this number comes out generally before the official government numbers. These aren't official government numbers, which I know you're probably laughing, thinking our government numbers aren't even official. But anyways, this is a private company. ADP does the payroll. 130,000 was the estimate. The number comes in at 206,000. And last month's was up, revised up by another 20,000. So a positive employment number comes out at 715. Then, suspiciously, once again, we have another pop after the market opens. And what is that pop about? Well, Chicago Purchasing Manager number was leaked early. 62.6 was the number. Estimate was for 58.5. Another positive economic report. So up we go. So we're up about 400 points. We start to kind of trail off throughout the day. And then late in the day, we get this big surge and finish up quite a bit. About 4% across the board. And you can see all the other economic data that came out today. And it was all, for the most part, pretty positive. You also had the Beige Book late in the day, about 1 o'clock our time. But everything in the actual column here you can see was higher than the estimate. So, it just fed on itself. And we were still oversold despite the Monday rally of 300 points or whatever it was, and coming in yesterday with a 32-point rally in the Dow. We were still oversold, so we got this huge burst up. But I want to show you something interesting. This is what I've done is this is the change in the S&P 500 over a 3-day period. Now, and it's going all the way back to 2008. And so what it's showing you is each bar is the total return for a 3-day period. As you can see on the right, we've got a 3-day period of 7.62% the last 3 days. And that's quite high. In fact, it's a little higher than what we saw earlier in the year right up in this area. So this is the highest 3-day gain we've seen going all the way back to March of 2009, which sounds very bullish. But one thing I think that's interesting is look how flat this band is in here. This was in early 2008, and then, of course, the crisis started, and we had this big change. I mean, we had days where the markets were going up and down over a 3-day period 10, 12%, and down 10 or 12%, and it was back and forth. It wasn't one direction. It's very important. And then, of course, the recovery started. Things were a little smoother. We didn't have quite the volatility. Had a few blips and with the flash crash. But now you can see we're starting to expand once again. And I know this kind of looks like a dumbbell or something, but pardon my drawing. My circles aren't perfect. But you can see the point is, let me take this off here, but the point is where the volatility is starting to pick up again. And in early August, we saw a 3-day period where the markets went down about 12%, and then it followed up with a 7% rise, 8% rise, back down again, and we're getting this volatility. So this isn't something new. And again, you only have to go back to 2008 to see what's going on, is that the stock market right now is showing that it's very uncertain. And if you go back to 2008, you'll remember there was not just one move higher and that was it. There was a lot of uncertainty, and there were days where the Fed would come in, TARP had to be passed, this bailout had to happen. Some news event that sparked a big 3-day rally, and we can see them in here. And then they were followed by big, nasty 3-day, reversals. Look, I hope this turns into a bull market. Bull markets are easier than bear markets for sure, especially what's gone on in 2011. It's been a very crazy year with the volatility. But the point is that 2008 was very similar to what we're seeing now. This data that we're getting on the economy hopefully will continue to get better. But I think some of these are blips. I think some of these numbers can't be trusted, and I think sometimes you get these big revisions down. And we're seeing consumer spending pull back. So the fact that people are out there buying on Good Friday, or excuse me, not Good Friday, Black Friday, the fact that they're out there buying on Black Friday and putting it on credit cards, go take a look at MasterCard. Credit cards are doing pretty well right now. People don't have the money, but I don't know if it's to make themselves feel better, but they're out there buying. But the personal income is going down, and that's a big concern. But the volatility is picking up, and you can see it here on this chart, and so it doesn't just go one direction. So volatility is going to be here for a while. Now, as far as where the markets are and where they might go, because that's really what this is all about. You can see that we did break this downtrend, went, of course, below the 200-day moving average right in this point, and we broke this support. And that was in early August, and really November was shaping up to really feel just like August, wasn't it? The cascading down, we had 7 down days in a row. And as I mentioned last podcast, it would have been much easier to have the market come down, into this range right in here. And that would have set up for a nice inverse head and shoulders, but stock markets don't always do what what we want them to do. I think the markets were setting up for a rally. Obviously, nobody saw this type of move that big over a 3-day period. But as I've pointed out just in the previous chart, big rallies occur in bear markets sometimes. So I don't think the volatility is over. I don't think we're in the clear yet. But now we're in the middle. And it makes it very challenging because we're not oversold, we're not overbought. Now, I've changed this to a little zoomed in just a bit, but and I've taken off the support and resistance line. But what I did put in there was kind of the next thing, the next challenge I think the markets have, which is, number one, we've got this downtrend that had developed, and now we're back at the top end of it. And number two, we have the 200-day moving average, and the 200-day moving average is just right above here. So we may have a little bit here, but look, I mean, the bears are saying, hey, this thing's probably going to roll over right now. This is a good shorting opportunity, and down we go. Now, as far as the Santa Claus rallies, really the Santa Claus rally is the last week of December, or excuse me, the last week after Christmas and through New Year's. That's the Santa Claus rally, and typically that's a good week. But as far as December is concerned, which are approaching starting tomorrow, this is the last 10 years of performance for the S&P. And you can see it's kind of all over the map, but it does tend to be better. In fact, if you look at this was 2008, coincidentally, was the best month. We had about an 11% gain in 2008. And then the worst was down about 6%. That was in 2002. All the rest of them been hovering around 1% or so. This blue line's the average, and it's somewhere around 1.3, 1.4% for the month of December. So it's not necessarily that you always get a good December, but the fact that we were oversold, I thought we were setting up for a decent December. Didn't know that the markets would rally 7.5% in 3 days. But that's what happens. The markets sometimes don't do what we think, and that's why we must remain flexible. So I didn't do any trading today, and I think that I was wise not to. I want to underscore something for those of you that were short coming into today, and I know some of you were. This is why I've been very hesitant to short in this market, because you can have this type of stuff. Remember, markets A that are oversold, or B, you have people out there, the Fed, all these different agencies and governments, their goal is to get the market to go up, not down. And so when you're betting against it, you have to be right, and you have to be quick, and you have to get out when you have a gain, because these markets, everybody's doing everything they can, politicians included, to get the stock market to go up. And so you're fighting a losing battle sometimes if you're shorting it. And I think that doesn't mean that we don't short. It just means that don't overstay your welcome. And so for those that are short, sometimes if you've got the gain, go ahead and take it. So I think we may get to a point, and that's something that we need to watch. We may get to a point where we have an easy shorting opportunity, because we're going to get to the other end, right? This is like a big pendulum swinging, and we went down 7 days in a row, and now we're going back up to the top. And if we get to the 200-day moving average, or whatever the case, we could roll back over, and that may be our shorting opportunity. But right now, we're kind of in the middle, so don't be afraid to do some individual trades on some names, but keep your stops in there, because you could wake up tomorrow morning and the futures be down 300 because of something negative going on, just like they were up 250 this morning. I want to thank you guys that have donated to the site. There's a donate button on there to the blog, and fortunately, I don't live off of that. I have a day job, but it does help keep the blog going, and because it is a free site and we provide free information. So for those that have donated to it, thank you very much. I appreciate it. Don't forget to look me up on Google plus Karl Eggers, KarlEggers. KarlEggers.com is the blog. There is a free place up at the top right to subscribe, and also don't forget EggersCapital.com for the money management website. And throughout the day, if you want to follow me, breaking news, hate to say that, but things that I think are important and going to move the market, I put on Twitter. So that's twitter.com/Karl Eggers. All right, guys, have a good evening.